Thanks, Bob. Professor Graetz?
So I think I'll just begin by looking backwards for a moment and then looking forward. I think the birthday point is an important point. I celebrate my children's birthdays, and I thank the Lord for my own. And, you know, as you approach 100, which Mort Kaplan, I think, is the closest in the room to, you know, you just have to be grateful each year that you made it another year, but you don't have quite the same level of vigor that you had when you celebrate your children's birthday or when they celebrate them. So there is some loss of vigor in the income tax. I think that's fair to say. Secondly, when the income tax came in, it was not intended to be the major revenue source, the workhorse of the U.S. tax system. We had a tax on consumption. It was a very bad tax on consumption. It was tariffs. But we were basically taxing consumption in the form of tariffs. We now know throughout the world, a point I'll return to in a moment, that there are good forms of consumption taxes. There are forms that work, and we need to think about that. Leap ahead to the post-war era, and people are very happy to say, oh, we had rates of 91%, we had growth of 5 or 6%. Well, Europe was a shambles, Japan was a shambles, China was entering into a dark communist period, and we know, you know, nobody talked about the BRIC countries. If you had talked about the BRIC countries, we would have been talking about a nuclear contest with the Soviet Union and Russia, but not economic growth and so forth in these large consuming and producing nations. So, you know, let's not point to the post-war period. The '86 Act was a great moment for politics and for the income tax, in the sense that supply-siders and deregulators who wanted the income tax to be neutral, not to direct investment and so forth, got together with people who were interested in tax equity. They produced what was then a revenue neutral and distributionally neutral tax reform. They financed, importantly, they financed the individual rate cuts out of corporate tax increases, which I think, for reasons that Bob has hinted at, is no longer possible. They also financed the corporate rate increases by repealing the investment tax credit and depreciation allowances that had gotten incredibly generous. So there was a pot of gold from which to finance rate cuts. And there is no pot of gold today. I think that became clear in the presidential campaign, even to the average American. So I now regard, and then the rates crept up and the base got narrower, and we have, you know, 7 education exemptions and savings incentives and the like that don't work. I mean, nobody can plan to save for college based on the tax breaks and so forth. So we started using the income tax as the cure-all for every ill facing society or the economy. And we've tried that, and you know, you can take health insurance, you can take retirement insurance, you can take housing policy, you can take education policy, and it doesn't work. And we know it doesn't work, and the evidence is that it doesn't work. And these are not narrow special interest loopholes. These are broad, popular things that Americans rely on for their retirement savings and their health insurance and their homes and so forth, and not to mention the importance of the charitable sector to the country. So I don't think we can have a replay of the '86 Act. I guess I think of it as a promise that has failed. It was a good experiment, but I think it's no longer the way to think about tax reform. So let's look forward. So the question, I think, and this is where I think we're all in agreement up here, which is sort of interesting to me. The question is, what do we have to think about when we think about reforming the nation's tax code, which everyone agrees is broken? No one defends there's no save the code movement. If you want to start one, you know, go for it. But I don't think you're going to have 1 million followers on Twitter if you start a save the code movement. And so the question is, well, what do we need? And so I want to echo something Jared said, which is that if you look at our needs for revenues, which is what people are talking about, and you ask, what is the single most important factor in generating revenues, what's highly correlated with increased revenues, the answer is economic growth. And so we have to have a tax system that is conducive to economic growth. We also have to take the lesson of the enactment of the 16th Amendment in 1913, which is that the country will not stand for just a consumption tax as the only tax in the system. The reason we needed an income tax was because high income, wealthy people were not paying what the public regarded as its fair share. And so the income tax was put in, limited to high income people, to redress that problem and to solve a problem of concentration of income at the top. And we continue to have high concentration of income at the top. And I think one of the interesting facts, this goes to a point that Jared and Bob made, one of the interesting facts, if you look at distribution of income at the very top, is unlike the 20s, unlike the Gilded Age, a much higher proportion of that income is in wages. It is in labor income than it was historically. And that's important because that means it is less mobile than capital, and that a lot of the capital income, people have mentioned carried interest, which I suppose is everyone's favorite example. A lot of capital income is not really capital income, it's really wage income that should be taxed as wages. And so there's a misstatement even in the amount of capital income at the very, very top. So we've got to deal with the inequality. We've got to, particularly at the top, we've got to have fairness in the tax system. We've got to have economic growth. We have to take into account, and this is a very recent phenomenon. When I was at the Treasury in the 90s, and we were thinking about tax reform for corporations, we thought, well, for administrative reasons and to make it simple for people, put a single tax at the corporate level rather than the individual level. And this was in 1992. Well, if that was right then, and I don't want to confess it was wrong, I might under pressure, but I don't want to confess it immediately. If it was right then, it's clearly wrong now. That is to say, the interrelationship, I mean, you talk about globalization doesn't have any meaning. The interrelationship, the ability to move money around, to move intangible income around, and so forth, that exists today just didn't exist in 1992, and that's only 20 years ago. And so we've got to have a system that works well in a global, technologically sophisticated, mobile world economy. And I think it's a mistake to think otherwise. And we have to have a system that fits well with international relations. The economists, just to pick another historical moment, beginning with my late good friend David Bradford, urged unique forms of consumption taxes. His ultimately became the X tax, which is a variation of a subtraction method, value-added tax. I'll spare you all of that. The point is, we cannot have a unique consumption tax. President Bush's panel in 2005 proposed a form of this tax, which they called the growth and investment tax. It wasn't a tax on growth and investment. It was a tax designed to achieve growth and investment. It was this form of value-added tax, essentially, but because of the way it was done, they acknowledged that it would require the renegotiation of all of our multilateral trade treaties and all of our bilateral income tax treaties. So they proposed a reform that basically said, not only do you have to get it through Congress, signed by the president, but we've got to also get it through the multilateral world in order for it to take effect. And then somehow John Breaux, who was the co-chair of that committee, found himself in the Oval Office opening cabinets. He tells this story, looking for his panel's report, and saying, you know, the president said, well, this was President Bush, George W. Bush, what are you looking for, John? He said, I'm looking for my panel's report. I've never seen any mention of it around the White House. And the reason that it was consigned to the dustbin is that it did not take seriously the need to mesh well with international arrangements. And so if you're going to think about a consumption tax, you have to think about a border-adjustable, destination-based consumption tax that is a form of goods and services tax or value-added tax, which is used in 153 countries by last count in the world, including every OECD country except for the United States. So we have to have a system that is conducive to economic growth, fair, meshes well with international arrangements, and produces an adequate amount of revenue. And I here want to also echo something that other panelists have said. I don't think 18.9%, which is our historical revenue, is going to be enough to finance the nation that we are moving toward, given the demographics, given the distribution of income and wealth, and given the international economy. I think we're going to need something higher than that. You know, is it 20? Is it 21? I don't know. But you are putting a huge amount of pressure on the income tax if you are going to rely only on the income tax, or mostly on the income tax and payroll taxes, to produce that much revenue. So it should come as no surprise. I think we need an alternative revenue source. Now, if I had known that Chris was willing to plug books that were not published by tax analysts, I would have brought a couple. You know, I've got two or three, but the one that I would have brought for today is a book called 100 Million Unnecessary Returns, in which I discuss, and you can get it, I think, as low as 1 cent from some of the Amazon marketplace people. You have to pay shipping and handling, so it's not like I'm going to get rich off of this plug. You know, it basically goes through the tax reform proposals, but it also says, here's where we ought to go. Since the book was published, the Tax Policy Center, and this is unusual for the Tax Policy Center, through a grant from the Pew Charitable Trust, actually estimated the parameters of the plan I proposed, which was essentially a plan to return the income tax to its function pre-World War II, after 1913, but before the Second World War, as a relatively small tax on a thin slice of Americans, because I think you have to have an income tax and you have to tax capital in order to achieve the kind of fairness that we believe in. And so here's what the Tax Policy Center said. I was grateful, I should add, that they estimated that it would eliminate 111 million tax returns. Had it, for example, come out to be 98 million, it would have created embarrassment given the title of my book of 100 million unnecessary returns. But more importantly are the numbers they come up with. So what did they say? The question I put to them is, how could we have a tax system that is distributionally neutral compared to the current system and raises as much revenue? The idea is to create a system that would allow us to have, if you want more progressivity at the top, to have a little more progressivity at the top, that if you need more revenue, that would give us more than one option for finding revenue. And here's what they concluded. They concluded that a 12.3% value-added tax would finance a $100,000 exemption, let me add for those of you who have experienced the alternative minimum tax, indexed for inflation, a $100,000 exemption from the income tax. It would eliminate 111 million returns, which is about 175 million people from the income tax, because many of those are joint returns. It would allow you to have a 16% tax rate between 100,000 and 200,000, and a 25.5% tax rate above 200,000. Now, this was done before the fiscal cliff. They have assured me they're going to rerun it with the new baseline and so forth. And I suspect when they rerun it, you're going to need a 30% rate above 400,000 or 450,000 or something like that. So you may need a higher rate to keep it distributionally neutral at the very, very top. But the point is that you can have lower rates. The other pieces of this or that you have a 15% corporate rate. And I really have to say, I do not believe that you can have high corporate tax rates. And I'm not talking about movement of real assets. I'm just talking about where am I going to have my intangible income taxed? Where am I going to have my business risks taxed? And the answer is I can have them taxed anywhere. And there are lots of countries, think of nice islands in the Caribbean or off the shores of Europe or even Africa that are perfectly happy for you to have it taxed there, or even Luxembourg, Switzerland, and Singapore, just to mention three landlocked nations, that are perfectly happy. If you'll just run some income through there, they'll take a little share of it and they'll call it their income. That's well and good. So income flocks to low tax countries and deductions flock to high tax countries. So all the borrowing is occurring here against our 40% tax rate, and the income is showing up somewhere else. And I've got a 90-page article about to come out in the Columbia Law Review. I have to say, as a footnote, there are now 450 footnotes due to the Columbia Law Review editors. And I've come to think now of law review editors doing footnotes in Columbia Law School the way I think about midnight basketball in Harlem, which is it keeps people off the streets at night, and it doesn't do any harm, but it's not doing anybody any good either. So I apologize for its length. I would have wished it to be shorter in all sorts of ways. But on the taxation of international income, patent boxes, R&D incentives, manufacturing incentives, and the shifting of intangible income abroad. So I'm happy to talk about those issues. I think you have to have a low corporate tax rate. I've said 15%. I think that's about as low as you can go, and I think that would actually, given our advantages, the size of our country and our resources and so forth, be competitive. It certainly would be a lot more competitive than anything anybody else is talking about. And then there is a debit card. Again, I'll talk about this if people want to. I don't just want to mention it. There's a debit card and payroll tax offsets to keep middle and low income people free. And the work that the Center for Budget and Policy Priorities did on the carbon tax offsets actually provides a lot of guidance as to how those debit cards would work. But the short answer is you go to a checkout counter and you're exempt from VAT because you've got a debit card that gets filled up the way we fill up debit cards for food stamps. So that this is distributionally neutral and revenue neutral, but it creates a system that would allow you, if you need to tax more than 53% of the people or whatever the income tax now gets, it would allow you to do that. It can be transparent, and I want to mention something about transparency, and that is I insist that the amount of value-added tax be shown on the receipt and not buried in prices the way it is in Europe. And people talk about how transparent the income tax is. So when I was at the Yale Law School, I conducted a survey. I walked the hall. This was not a scientific polling survey. I walked the hall. I asked students, staff, secretaries, laborers, faculty of the Yale Law School, and a couple of economists how much income tax they paid last year. This was in late April. And the overwhelming answer I got was I got a refund of $1,000. And so nobody knows how much income tax they pay, and you think about it yourself. Do you know how much income tax you paid last year? And the answer, I think, is since we've gotten withholding, probably not so much. The last thing I want to say, and I think this is important, is I want to say something nice about Google Maps, which Jared has really said something not nice about, and I own no.
Tax collector.
I understood. I own no Google stock, I should say, and no Google products except the one that I use all the time, as we all do, searching. I told my children were talking about politics. My children are in their 20s and 30s now, and they were talking about politics in the United States. And I said, here's an experiment I want you to conduct to show you how much politics matters. I want you to look at Google Maps and look at a map of Korea at night. And you'll see North Korea in darkness, and you'll see South Korea blazing like the sun. And the reason for that is that South Korea has been well governed. And South Korea made the transition from textiles to Samsung and Hyundai and sophisticated, highly technological products, and the North Koreans are in darkness. And this is not, and this I don't mean to say that character and history and culture are not important. They're extremely important. But there you have a nation where the character and the history and the culture of the people are essentially the same, and the big difference is in their politics. And we, the people, need to reassert ourselves in making our politics work, because there are many risks for American prosperity and well-being in the global economy. And I think the one that is the biggest at the moment is our broken political system.
You see why I like coming to income tax conferences?